Right now, in 2025 and into 2026, two of Europe's heavyweight economies, Germany and Italy, are under serious domestic pressure to pull hundreds of billions worth of their gold reserves out of U.S. vaults. We're talking about politicians, economists, and influential voices openly questioning whether it's still safe to keep that much sovereign wealth under the custody of the New York Federal Reserve. This isn't some fringe conspiracy. These are mainstream calls, growing louder, driven by geopolitical tensions, tariff threats, and a deep unease about the current direction in Washington. So I have to ask you, what do they know that most people still don't? Let's go back. After World War II, and especially under the Bretton Woods system, European nations were encouraged, quietly pressured even, to store large portions of their gold in New York. The official story was simple. It was safer there, more liquid, and it made international transactions easier under American protection. But there was another side to this arrangement that rarely gets talked about. By parking their gold in the U.S., these countries effectively bolstered the dollar's status as the world's reserve currency. It gave the United States enormous implicit leverage, because as long as everyone's gold was sitting in American vaults, the dollar remained the uncontested king. It wasn't just custody. It was a subtle form of financial influence that quietly anchored the entire post-war monetary order. Here's the basic mechanics you need to understand. Central banks treat physical gold as the ultimate reserve asset, the one thing that holds value when everything else is in question. Germany still has roughly 1,236 tons stored at the New York Fed. That's about 37% of their total holdings. Italy has a significant portion there as well. The key point is location. Dollar-denominated assets, treasuries, reserves in the U.S. financial system, they can be frozen or sanctioned with the stroke of a pen, as we've seen happen to other nations. But physical gold bars sitting in your own national vault? Those can't be touched remotely. In a real crisis, possession is everything. And right now, major European players are starting to act like a crisis of confidence might be closer than anyone wants to admit. Let's talk about the catalyst that's pushing this whole thing forward right now, in early 2026. The calls aren't coming from fringe voices anymore. They're coming from mainstream German economists, lawmakers across parties, even the German Taxpayers Association. Just in the last few weeks, we've seen public statements and open letters urging the Bundesbank to bring home the remaining 1,236 tons still stored in New York. The reasoning is straightforward: rising geopolitical risks, questions about the stability of transatlantic relations, and a U.S. administration that has openly talked about tariffs, trade wars, and rethinking old alliances. In Italy, similar pressures are building. Politicians and commentators pointing to the same doubts, questioning why any sovereign gold should remain vulnerable to foreign political shifts. They're gaining traction in parliaments and financial circles because the old assumptions about unbreakable U.S. custody no longer feel certain. Here's the trap Germany and Italy find themselves in, and it's a genuine no-win scenario. If they leave the gold where it is, they remain exposed to the exact risks that everyone saw play out with Russian assets. One executive order, and access could be restricted or leveraged in a dispute. We've already seen how quickly dollar-based reserves can become political tools. But if they repatriate, even gradually, they send an unmistakable signal to the world. Two of America's closest allies no longer fully trust the dollar system to protect their ultimate store of value. That public loss of confidence accelerates the very erosion they're worried about. Other nations watch, markets react, and the perception of dollar dominance takes a permanent hit. Either choice feeds the same outcome, a quiet but irreversible shift away from the post-war arrangement. And that's where the chain reaction starts. Once major European nations seriously entertain repatriation, it emboldens everyone else. Emerging markets, many of whom never fully trusted the system to begin with, see validation for their own strategies. Look at what's already happening. central banks globally bought another 863 tons of gold in 2025 alone, keeping purchases near record levels even as prices climbed. Countries like China, India, Turkey, Poland, they've been consistent net buyers for years, building domestic holdings at a pace we haven't seen since the collapse of Bretton Woods. BRICS nations continue pushing de-dollarization initiatives, expanding trade in local currencies, developing alternative payment systems. Each step reduces day-to-day reliance on the dollar. The dollar's share of global reserves has been quietly sliding for 2 decades, from over 70% in 2000 to around 58% today. And moves like these from Europe only accelerate that trend. One domino tips, and the rest start leaning. The most important part to understand is how powerless the institutions actually are to stop this. The Federal Reserve doesn't own that foreign gold. It's held in custody voluntarily. No treaty forces countries to keep it in New York. Once trust erodes enough that repatriation becomes politically necessary at home, the Fed can't block it without triggering an outright diplomatic crisis. They can delay, they can negotiate, but they can't say no forever. And every bar that leaves those vaults is a permanent vote of no confidence, one that can't be undone without even greater loss of face. The process is slow, deliberate, and almost impossible to reverse once it gains momentum. This is where the divide between paper wealth and physical reality becomes impossible to ignore. Most foreign reserves are held in dollar-denominated assets, treasuries, agency bonds, cash balances, ETFs. Those are ultimately just digital claims on a system that can be sanctioned, frozen, or devalued through policy decisions. We've seen it happen. But physical gold bars, serially numbered and stored in your own national vault, are different. No foreign power can seize them remotely. No sanction can touch them without physical invasion. In an environment where trust is fraying, the difference between a paper promise and actual possession becomes the difference between preserved wealth and vulnerability. That difference is already driving a massive transfer of real purchasing power. On one side, savers, pension funds, institutions heavily exposed to dollar assets and U.S. debt. If confidence continues to erode, higher borrowing costs for the U.S., persistent inflation pass-through, and currency depreciation eat away at what those holdings can actually buy. On the other side, nations and increasingly informed individuals who have positioned themselves in physical gold. As central banks keep bidding to build their own holdings, they push prices higher in a self-reinforcing cycle. The wealth doesn't vanish. It quietly shifts to whoever understood the signals early and acted on them. And the signals from insiders have been consistent for years. Central banks, especially in emerging markets, haven't just talked about diversification. They've executed it relentlessly. Hundreds of tons added quarter after quarter, even at all-time highs. Now, European voices that once dismissed full repatriation as unnecessary are openly reversing course. Politicians who downplayed concerns a few years ago are now acknowledging the changed landscape. When the people who manage the system start protecting themselves first, it's worth asking why private portfolios are still following decades-old conventional wisdom. That conventional wisdom, the idea that U.S. Treasuries are eternally risk-free, that the safest diversification is simply more dollars or dollar-denominated bonds, is dying right in front of us. When America's own allies begin questioning whether their ultimate reserves are safe under U.S. custody, the foundational assumption of the entire dollar system is called into doubt. The old rules were built on unquestioned trust. That trust is no longer unquestioned, and once it's gone, it doesn't come back easily. Now let's make this personal, because this isn't just a story about central banks and politicians in far-off capitals. It's about what happens to your money, your purchasing power, your future when the foundation of the global financial system starts to crack. If dollar confidence continues to erode the way these signals suggest, the effects ripple straight into everyday life. A weaker dollar means imported goods, everything from electronics to clothing to food, cost more at the store. Energy prices stay elevated or spike again because oil is still priced globally in dollars. Persistent inflation becomes harder to tame, eating away at wage gains and fixed income returns. Savings accounts, retirement portfolios heavy in bonds or dollar-denominated assets, lose real value quietly over time. Stock markets tied to the U.S. economy face sharper volatility as borrowing costs rise and foreign capital flows slow. It's not necessarily a sudden crash. It's more often a slow grind that leaves most people wondering why their standard of living feels stuck or slipping, even when the headlines say everything is fine. This is where the doom loop kicks in, and once it starts, it feeds itself. Repatriation pressure from major nations reduces demand for dollar assets as central banks diversify. Lower demand means the U.S. has to pay higher interest rates to attract buyers for its debt. Higher borrowing costs strain federal budgets, already running massive deficits, forcing either spending cuts, more money creation, or both. That adds to inflationary pressures and policy uncertainty. Uncertainty pushes more countries and institutional investors to question dollar exposure, accelerating diversification into gold and alternative systems. Gold prices rise as central banks bid aggressively, validating the shift and encouraging even more players to follow. Round and round it goes, each turn reinforcing the last. The loop isn't easy to break because no single actor can stop it unilaterally without making their own position worse. History gives us a clear echo of exactly this pattern. Go back to the late 1960s. France, under de Gaulle, openly distrusted the dollar's stability and began aggressively repatriating gold from New York, literally sending warships across the Atlantic to collect it. Germany followed with its own withdrawals. Other nations watched and started pulling reserves too. The pressure exposed the fragility of the Bretton Woods system. The U.S. was printing more dollars than it could back with gold at the fixed price. By August 1971, Nixon had no choice but to suspend convertibility, closing the gold window and ending the era of dollar backed by gold. The moves we're seeing today mirror that loss of confidence almost beat for beat. Close allies questioning the safety of U.S. custody, central banks stockpiling physical metal at record pace, and open political debate about bringing the gold home. What we're witnessing is nothing less than the transition to a new era. The unipolar world where one currency dominated global trade, reserves, and debt markets is giving way to a multipolar reality. In this new landscape, national control over real assets matters far more than promises denominated in someone else's currency. Power shifts toward countries and individuals who prioritize tangible stores of value over paper claims. Alliances become more transactional, payment systems fragment, and physical gold reasserts its role as the neutral, apolitical anchor it has been for centuries. The old era rewarded blind faith in the dollar system. The emerging one rewards clear-eyed preparation. That's why understanding these signals early puts you in a different category altogether. Most people will remain fully exposed, savings in cash or bonds, retirement accounts tied to traditional portfolios, reacting only after the shifts are impossible to ignore. But those who recognize what central banks and now European politicians are doing can position deliberately, allocating to real physical assets that can't be frozen or devalued at a distance, building resilience outside the parts of the system showing the clearest strain. It's not about panic or speculation. It's about aligning your strategy with the same logic the insiders are already following. The informed don't just survive shifts like this. They come out the other side with their wealth intact. So what do you actually do with this information? I'm not going to pretend there's a single magic button that shields you from every risk in a shifting monetary landscape. Anyone who tells you that is selling something. But there are clear, rational steps you can take. Steps that mirror exactly what the most sophisticated players in the system are already doing. First, internalize why central banks have been accumulating physical gold at the fastest pace in modern history. It's not speculation. It's not nostalgia. It's the recognition that when trust in paper systems frays, the only asset that retains value across regimes, borders, and crises is the one you can hold, audit, and control directly. No counterparty risk, no remote freeze, no political leverage. That's why nations are willing to pay record prices to stack it in their own vaults. From there, the honest conversation starts with your own portfolio. If you're like most people, the majority of your wealth is tied, directly or indirectly, to the dollar system. Cash, bonds, equities denominated in dollars, retirement accounts benchmarked to US markets. That exposure made sense in an era of unquestioned dominance. It makes less sense when the architects of the system itself are quietly hedging. A prudent response isn't to panic sell everything overnight. It's to thoughtfully allocate a meaningful portion toward real scarce assets that perform precisely when confidence in the current order weakens. Physical gold, bars or coins you can store securely, is the clearest parallel to what sovereign nations prioritize. It's not about timing the top or bottom. It's about transferring some purchasing power into an asset class that central banks are bidding higher year after year. Do your due diligence on reputable dealers, secure storage options, and the tax implications in your jurisdiction. Think in decades, not news cycles. The goal isn't to get rich quick. It's to avoid being quietly impoverished slowly. But that's only part of the picture. There are specific strategies savvy individuals and family offices are using right now to navigate this environment. Ways to structure holdings, minimize counterparty exposure, and position for the multipolar reality that's already emerging. I'm not going to lay out the full playbook here, because this shift is still unfolding, and the most effective moves require precise timing and context. The complete breakdown, step by step, no fluff, is coming in the next video. This story is moving fast. We're barely into 2026, and the signals are getting louder. More countries are watching Germany and Italy closely. If even one major player begins quietly moving bars home, the dominoes tip faster than most expect. You don't want to be the person who sees this clearly today and then misses the follow-up that spells out exactly what to do next. If this opened your eyes even a little, hit the like button. It tells me this is worth keeping going. Subscribe and turn on notifications right now, because the next video drops soon. You've made it this far. Don't stop here.